Most Australians believe that once you turn 60, retire and access your super, it all becomes tax-free. That sounds great, it's also not entirely true. Yes, age 60 is a key point when it comes to your super, but not everything is tax-free, and if you assume it is, it can lead to some costly mistakes. In this video, I'll walk you through exactly how the tax rules work at 60, what is tax-free, what isn't, and 2 powerful tax strategies most people overlook. Because when it comes to your super and tax, 60 is an age you really need to understand. Hey, I'm Chris Strano, founder of superguy.com.au and managing partner at Toro Wealth, where our vision is to be Australia's most trusted retirement planning firm. If you're new here, hit subscribe for regular retirement planning tips. And just a reminder, this video is general information only, not personal advice. Now, turning 60 might not excite everyone, but it does unlock some pretty valuable tax benefits. So let's start with what becomes tax-free when you turn 60 and retire. First, pension payments. When you retire, most people convert their super into an income stream, usually through what's called an account-based pension. That simply allows you to receive regular income from your super, whether that's fortnightly, monthly, or annually, paid directly into your bank account. And here's the key point. Once you're 60, those pension payments are tax-free. And this rule doesn't just apply to account-based pensions, it can also apply to defined benefit pensions and transition to retirement pensions. Okay, second, lump sum withdrawals. Same deal. Once you're 60, any lump sums you withdraw from a super accumulation account are tax-free. So in addition to, or instead of setting up an income stream, you can withdraw super as a lump sum. And that simply means taking out a one-off amount. So if you want to take out $100,000 to pay off the mortgage or withdraw $50,000 to do a big lap around Australia, it's tax-free. Or use the cash to finally renovate the kitchen that's been on the to-do list for about 15 years. Also tax-free. But, and this is important, there's one sneaky trap that can catch people out, the untaxed component. In rare cases, your super balance might include what's called an untaxed component. If it does, that portion can still be taxed even from age 60. Now, this usually comes from insurance proceeds paid into super or from certain superannuation schemes, particularly for public sector workers where no contributions tax was deducted upfront. Most people don't have an untaxed component, but if you're unsure, contact your super fund and ask, because it won't usually be on your statement, so you'll need to check directly. If you've got a self-managed super fund, your accountant will know. By the way, if you want a simple way to check key things such as this in your own super, we've put together a free superannuation checklist. You'll find the link in the description below. So those are the first 2 things that are tax-free from age 60, income payments and lump sum withdrawals. But there's a third area that causes the most confusion, tax on superannuation investment earnings. A lot of people assume that once they turn 60, their super earnings are tax-free. Your age has actually nothing to do with how super earnings are taxed. What matters is whether your super is in accumulation phase or pension phase. Let me explain, because this is where the details really matter. While you're working, your super sits in an accumulation account. The money is invested, and those investments generate returns in the form of dividends, distributions, rent, interest, and capital gains. In accumulation, those earnings are taxed at 15%. Capital gains are also taxed at 15%, but if you've held the investment for more than 12 months, that effectively drops down to 10%. And this is true regardless of your age. If your super is in accumulation, earnings are taxed. But here's where it changes. Once you transfer your super into a pension account, which can usually only be done once you're at least age 60 and retired, or 65 if you're still working, your super moves from accumulation phase into retirement phase, and that's when investment earnings become tax-free. It's the same money, but now you have 0 tax on earnings. Now, you can leave your super in an accumulation account for as long as you like, and some people do for various strategic reasons. But if it's just sitting there for no reason, you're losing thousands to tax. This single shift, moving funds from accumulation to pension phase, is one of the biggest tax advantages available in retirement. The only catch? You need to withdraw at least the minimum pension amount each year, so you've got to actually use it, which, let's be honest, isn't the worst problem to have. Now, one important note, this tax-free treatment doesn't apply to transition to retirement pensions. If you're still working and drawing a TTR pension, your earnings are still taxed at 15%, just like an accumulation account. So to be clear, turning 60 doesn't make your super earnings tax-free. Moving into pension phase, like starting an account-based pension, does. Now, before we get into 2 tax strategies you should be thinking about, there's one more thing you need to know about super earnings, and it's brand new. From 1 July 2026, there's a new tax rule that applies to larger super balances. If your total super balance across all your funds exceeds $3 million, an additional 15% tax will apply to the earnings linked to the portion above that threshold. That brings the effective tax rate to those earnings to 30%. Now, let me be clear. This doesn't affect most people, but if your balance is approaching that number, there are a few things worth knowing. First, it only applies to the portion above $3 million, not your entire balance. And second, it includes everything, anything in your regular accumulation accounts and pension accounts like an account-based pension. It's all counted towards the $3 million. So for those with larger balances, particularly in SMSFs with property or other illiquid assets, the question becomes, is super still the best place to hold everything? For many people, it still will be, but structure matters. Asset location matters, and it's a conversation worth having with your financial planner sooner rather than later. So understanding the rules at 60 is important, but it's only part of the picture, because there are a couple of tax strategies you should be thinking about as you approach retirement, and most people miss them. We'll just be covering 2 today. If you want a deeper dive into other strategies, I've done a full video on this and the link is in the description. So the first strategy is carry forward concessional contributions. Right now, the concessional contribution cap is $30,000 per year. From 1 July 2026, that increases to $32,500, but here's what most people miss. If your total super balance was under $500,000 on the most recent 30 June, you can also use any unused amounts from the previous 5 years. These are called carry forward contributions. And that means in theory, you could contribute well over $150,000 into super in a single year and claim a tax deduction on the entire amount. And done right, that could save you tens of thousands of dollars in tax in a single year. We see this work particularly well for clients facing a capital gains event like selling property or shares, times when a large tax bill is already on the horizon, or even just for high-income earners. Additionally, once the money is inside super, your investment earnings are taxed at only a maximum of 15%. Compare that to keeping it outside super, where earnings could be taxed at your marginal tax rate, which is often higher. This can help accelerate your long-term wealth because more of your investment returns remain in the fund and continue compounding over time within the concessional tax environment. Another quick tip on this with 30 June coming up, if your balance is at or around $500,000 mark now, you might want to think about ways to keep it so it's below $500,000 on the 30th of June 2026 so that you can utilize the carry forward contribution amounts next financial year too. Either way, you've got to get the timing and the calculations right, so speak to a financial planner or accountant before making large contributions. This isn't one that you want to guess and hope for the best. Let's move on to number 2, a transition to retirement strategy. If you're still working at 60, a transition to retirement strategy can be one of the most effective ways to reduce tax. And here's how it works. You salary sacrifice more of your income into super, which reduces your taxable income. That lowers the tax you pay on your wages. But of course, salary sacrificing means less take-home pay. So you start a transition to retirement pension and use tax-free pension payments to top up your income. Same income, less tax. You're effectively swapping higher tax income for tax-free income, and you're building your super at the same time. It sounds a bit technical, but the outcome is simple. You keep more of your money. I've done a full video breaking down exactly how a transition to retirement pension works, and you'll find the link in the description below. Whether you use these strategies or not, the key takeaway is this. If you're approaching 60, this is one of the most important windows in your retirement planning. Get it right, and you keep more of your money. But if you get it wrong, you'll hand more of it back in tax. At Toro Wealth, we help Australians 55 and over optimise their finances as they head into retirement. To learn more, head over to torowealth.com.au. And if you enjoyed the video, please give it a thumbs up and hit subscribe. Thanks for watching. I'll see you on the next one.